Big move on India. CapitaLand Investment just committed 2.8 billion to Maharashtra by 2030, anchored by its first data center there. I'm Iggy from the Investing Iguana. Here's why this matters to your Singapore portfolio. Myth. India is too messy, too far, too risky. Truth. Singapore capital is already scaling into India's new economy. Data centers, logistics, business parks, where demand is compounding fast. Structural demand. India's data traffic and AI workloads are exploding. Every new DC needs land, power, cooling, and long leases. That's infrastructure like cash flow with stable occupancy, inflation-linked escalations, and sticky tenants. Capital compounding, CapitaLand mixes development profits, recurring fund fees, and rental income. More DCs and parks lift AUM, fee income, and return on equity over cycles. Positive read-through. This is not one asset. It signals pipeline growth across India new economy assets that supports Singapore's DC ecosystem, operators, power solutions, contractors, and strengthens visibility toward AUM targets. But watch power reliability, timelines, permits, funding mix, and FX. What to do now? Map your Singapore list into 3 buckets. 1. Sponsors with India new economy pipelines and proven fund platforms. They scale and monetize through fees. 2. Singapore names tied to DC development, power, and design. Beneficiaries of DC capex cycles. 3. REITs or vehicles with India or DC exposure where lease tenor, power contracts, and land tenure are clear. Read the funding footnotes, track ROIC and fee-related earnings. Iggy's view? This is a medium-term compounder theme, not a one-quarter trade. Prefer sponsors with co-invested alignment, visible AUM growth, and discipline on power and land. Size positions so execution risk won't sink your portfolio. Bottom line, 2.8 billion to Maharashtra is a signal. Follow the cash flows, the power contracts, and the fee growth. That's where returns compound for Singapore investors.